If the Federal Reserve spent 12 years, 14 years creating an economy built on a foundation of basically free money, what happened during that 12, 14-year time period when money was free? How many misallocations of resources? How many malinvestments? How many bubbles were inflated? How much did we overconsume and underinvest? How much excess debt was piled up during that period? Now that the Fed has to remove all of those supports that the economy was resting on top of, everything that was built on those supports has to come crashing down. It's not like the economy can just levitate in midair when you pull out the supports. It has to implode. So there is no way to normalize interest rates after more than a decade of abnormally low interest rates and not let everything come toppling down. And that was the point Nassim Taleb was trying to make. This is going to be a disaster. All of a sudden, this is a new world where you have a positive interest rates, or not even positive yet. Maybe we're going there, but there is a cost of capital. You have a discount rate now. This impacts everything, and this is changing the world. And he pointed out that a lot of the people who are managing money have no idea what it's like to manage money with a normal interest rate, let alone high interest rates, because ultimately that's where we're headed. We're not just headed for normal interest rates. You don't go from over a decade of artificially low interest rates to normal interest rates. Pendulums don't swing that way. They don't go all the way to one side and then just stop in the middle. We're going to swing all the way to the other side. So we're going to go from very low interest rates to very high interest rates. Now, how long it's going to take to get there, I don't know, but that is where we're headed. And if you think about it from a fundamental perspective, we deserve high interest rates because interest is the price you pay to borrow money, but prices are determined by supply and demand when the Federal Reserve is not artificially influencing it. But eventually supply and demand overwhelms the Fed, and we're going to have a rate of interest that reflects the actual balances in the economy between savings and borrowing. But if you have an economy where you have a lot of savings and not too much borrowing, then you can naturally have low interest rates because you have a lot of supply, lots of savings, and not too much demand. Not that many people want to borrow. But the U.S. economy is the opposite of that. Nobody wants to save, and everybody is trying to borrow. So we have hardly any supply. We've got lots of demand. So the price to borrow should be higher. And of course, the more debt you have, the riskier you are as a borrower, which means lenders have to charge a higher premium, especially for the U.S. government, which is loaded up with debt. It's a much risky borrower now than it's ever been, yet it's gotten away with extremely low interest rates. Everybody still believes that the Fed is going to get inflation back down to 2% very quickly. It's just going to work a little harder to achieve that goal, but everybody believes they're going to get there, and that's why bond yields are so low. And in fact, there's a lot of stocks that are going to go bankrupt. A lot of household names are going to go bankrupt because a lot of household name companies still lose money. They operate in the red. Now, that wasn't a problem when money was free and they can issue stock and they could take the proceeds from selling stock and use that to pay their workers or pay their rent or other operating expenses. But those days are coming to an end. And so a lot of these companies that never should have come into existence will no longer be in existence. They are going to go bankrupt and their shareholders are going to lose everything. Once the economy really starts to buckle, the Fed is going to turn. I'm confident that the only reason Powell is talking so tough on fighting inflation is that he's still delusional enough to believe that he can do it without destroying the economy. Is he willing to put the economy in a mild recession where unemployment tweaks up a little bit? Sure, why not? That would be getting out of Dodge with barely a scratch. So yes, he's willing to do that. But is he willing to create a worse financial crisis than 2008? Is he willing to put the economy in the equivalent of a depression, a great recession worse than the one we had in 2008? Of course not. He has zero tolerance for that, but he doesn't expect that. And neither does anybody else. No, it's amazing. Every time I hear somebody talking about the U.S. economy going into recession, conceding that we'll probably go into a recession, ignoring the fact that we're already in one. We've already had 2 quarters of negative GDP, so technically we're in a recession, but some people are ignoring that and they think, well, we're probably going to have a recession. But everybody says with a high degree of confidence, by the way,
that the recession is going to be short and shallow.
How do they know that?
And why should it be short and shallow?
The bust needs to be proportionate to the boom. We've never had a boom this big. We've never had interest rates this low for this long. We never had an economy more screwed up than the one we have right now. We've never had bigger asset bubbles, bigger debt bubbles, more misallocations of capital and resources. So we have more mistakes that we need to fix now than ever before. So how are we going to do that with a short, shallow recession? We're not. It's going to be a massive recession. And again, the Fed has no stomach for that. And that's why the Fed is going to pivot. But the problem is when they do pivot, it's not going to be like the pivot from 2020 because they're going to be pivoting when inflation is still well above 2%. It'll probably still be well above 4% or 5% or 6%, wherever. We're still going to have very high inflation. And again, that's why all these people who are buying the long end of the curve on the bond market, like the Jeff Gundlachs, the reason they're doing that is because they're betting on a pivot. Well, they're right. We're going to get a pivot, but they're going to lose their wagers because when the Fed pivots, the long end of the bond curve is going to get killed. And the reason is that right now the long end is being supported by the perception that the Fed is going to succeed in reducing inflation back down below 2%. But if they have to pivot when inflation is well above 2%, and then they have to go back to highly inflationary monetary policy, more money printing, more QE, slashing interest rates, inflation is going to take off, and that's going to kill the bond market. Bonds are going to get obliterated when the Fed pivots. Maybe not the immediate reaction, maybe the knee-jerk reaction could be a rally, but that rally will be very short-lived. And by the way, the Fed's balance sheet expanded by $10.4 billion. We're still looking at an $8.833 trillion balance sheet. The balance sheet has barely shrunk. They're selling, yes, it's down slightly from where it was, but look at how much rates have moved up based on this tiny reduction in the Fed's balance sheet. Imagine how much more rates would move up because how much lower bond prices would fall if the Fed actually started unloading a larger quantity of bonds on the market. And by the way, I don't even think they're selling treasuries yet. I think they're doing mortgage-backed securities. So eventually they have to start selling U.S. treasuries, which is going to put even more downward pressure than there is right now. And also, by the way, the Atlanta Fed came out yesterday and did exactly what I've been predicting they would do, lower again their estimate for Q3 GDP. The last estimate was 1.3%, and now they've lowered it all the way down to 0.5%. Back in August, that estimate was above 2.5%. So they've already gone from over 2.5% to now just 0.5%. How much longer before that 0.5% turns into a negative number?